Imagine a world where traditional banks no longer exist. No Wells Fargo, no JP Chase, no central banks controlling the money supply. Every transaction happens on the blockchain, and your money is entirely yours. No government can freeze it. No bank can deny you access. This is the crypto dream. But if Bitcoin, Ethereum, and other cryptocurrencies completely replace traditional banking, would it bring financial liberation or economic catastrophe? For such a revolution to occur, major obstacles would need to be solved. Ethereum performs better but still faces limitations. Advanced Layer 2 solutions, improved consensus mechanisms, or entirely new blockchains would need to manage billions of daily transactions. Price stability would also be essential. Few people would buy coffee with Bitcoin if its value could swing from $60,000 to $30,000 overnight. Reliable stablecoins or algorithmic stabilization systems would have to mature. User experience must dramatically improve so that even non-technical users can manage wallets and recover lost keys easily. Finally, governments would need to adapt, creating regulatory frameworks to tax crypto transactions while surrendering significant control over monetary policy. If crypto fully replaced banks, the traditional banking industry would face devastation. Why keep savings in a bank earning minimal interest when staking crypto could yield significantly higher returns? Why pay wire transfer fees when blockchain transactions are near instant and inexpensive? Core banking functions, storing money, facilitating payments, issuing loans would be disrupted by decentralized finance (DeFi). Millions of jobs could vanish, branches could close, and financial districts might suffer economic decline. Yet the enormous costs of maintaining banking infrastructure would shrink. Compliance systems, fraud prevention, physical offices would shrink, potentially making financial services far cheaper. Banks would resist fiercely, lobbying governments and warning about crypto risks. Some might adapt into crypto service providers, but their long-standing dominance would likely end. On the positive side, financial inclusion could dramatically expand. Around 1.4 billion people worldwide lack access to basic banking. With crypto, anyone with a smartphone and internet access could participate in the financial system. No bank account, credit history, or government ID required. Migrant workers could avoid high remittance fees. Rural communities could receive instant payments. Small businesses could access loans without corrupt gatekeepers. Individuals in authoritarian regimes could store wealth beyond the reach of confiscation. Activists could receive funding without state interference. Financial sovereignty would become more accessible than ever before. However, serious downsides remain. Volatility makes planning difficult. Businesses cannot reliably budget if reserves fluctuate wildly, and salaries become unpredictable. Speculation often overshadows utility, with many users holding crypto as an investment rather than spending it, reducing economic circulation. A large-scale crypto crash without government backstops could rival or exceed past financial crises. There are darker risks as well. Crypto transactions are typically irreversible, send funds to the wrong address, or fall victim to a scam. And there is no bank or insurance to recover losses. Vulnerable populations could suffer disproportionately. Criminal activity, from ransomware to money laundering, could increase, especially with privacy-focused coins. Perhaps the greatest challenge lies in monetary policy. Today's central banks manage inflation, respond to recessions, and stabilize economies by adjusting interest rates and money supply. If a fixed supply cryptocurrency like Bitcoin dominated global finance, governments would lose these tools. Stimulus packages, bailouts, and quantitative easing would become impossible. Deflation could discourage spending, slow growth, and deepen recessions. While savings might be protected from inflation, economies would lack mechanisms to soften downturns. Even the promise of decentralization has complications. Mining power and wealth could concentrate among large operators and early adopters, creating new forms of financial elite power. Developers who maintain blockchain code would hold significant influence. Placing banks might not eliminate centralization. It could simply shift power to different actors. The transition itself would likely be chaotic. Bank runs, collapsing currencies, capital controls, and black markets could emerge. Credit systems might freeze, making mortgages and business loans difficult to obtain. Entire industries reliant on traditional finance could suffer during a painful adjustment period that might last years. Younger, tech-savvy individuals could benefit, while older or less technologically literate populations might struggle. A more realistic scenario may involve compromise. Governments are already exploring central bank digital currencies, CBDCs, such as China's digital yuan, or proposals for digital euros and dollars. These systems combine blockchain-like efficiency with centralized oversight, allowing governments to maintain monetary control while improving payment systems. The future may become hybrid. Government-backed digital currencies for everyday use, and decentralized crypto for those prioritizing privacy and autonomy. In the end, a complete replacement of traditional banking by cryptocurrency is possible, but highly disruptive. The benefits are compelling. The risks, volatility, crime, weakened monetary tools, power concentration, and transition turmoil are equally significant. Blockchain will almost certainly transform finance, but whether that transformation is revolutionary or evolutionary remains uncertain. A balanced evolution may be the most realistic and beneficial outcome.